You likely know someone in the Daniel trap. He is 42, earns $55,000 a year, and has spent the last half-decade waiting for a disruptive, socially prestigious startup idea to strike. This waiting period is expensive. He spends hundreds each month on software subscriptions and networking dinners that yield nothing. Over 5 years, that is $36,000 evaporated, capital that could have launched a real operation. Alex took a different route. He spent $3,500 on a commercial pressure washer and $30 on business cards. By the end of his first year, he had a contract with a local homeowners association. Today, his business bills over $180,000 annually. The barrier for most people isn't a lack of ideas, it's the social stigma of blue-collar labor. They would rather struggle as a founder than thrive as a service provider. When we map prestige against profit probability, the conflict is clear. High-prestige startups often carry the highest failure rates. Low-prestige services, like pressure washing, occupy the high-probability corner of the market. Choosing financial independence usually requires a specific trade, giving up social glamour in exchange for the cash flow generated by undeniable market demand. In the book The Millionaire Next Door, researcher Thomas Stanley found that most consistent millionaires aren't building apps. They are the owners of local utility and maintenance companies, businesses that look unexciting from the outside, but generate steady wealth. This isn't a niche observation. Data from the Small Business Administration shows 36 million active small businesses in the U.S. heading into 2026. 82% of those 36 million businesses are run by solo operators. This confirms that a massive corporate infrastructure is not a prerequisite for success. These models are proven. The real task is determining which one fits your specific balance sheet and how much time you are willing to trade for growth. To categorize options, we use an asset quadrant. The vertical axis is capital. The horizontal is operational effort, from passive to active. The first category is sweat equity. Businesses like trash hauling and parking lot striping require low cash, high effort. You can launch these for under $5,000. The primary investment is your own time spent on sales and execution. Parking lot striping is a prime example. Every commercial lot is legally required to keep its markings completely clear. With a $5,000 machine, an operator can generate up to $2,000 in a single afternoon. Then there is the wash and fold model. By securing 100 recurring clients who spend $40 a week on laundry, you can generate $16,000 a month in gross revenue. This model has a hidden advantage. You don't need to own the machines. You can partner with existing laundromats to do the cleaning while you handle the pickup and delivery logistics. The trade-off for Category 1 is simple. You gain high margins and avoid debt, but you are buying yourself a physically demanding full-time job. Moving up the capital axis, we find scalable micro-assets, like vending machines. These require more money up front, but reduce the amount of physical labor required per dollar earned. Launching involves deploying machines for under $10,000 each and negotiating for high-traffic real estate in gyms or office lobbies. The business has existed for decades because it removes the need for a human at the point of sale, operating as a 24-hour storefront. In modern environments, a well-placed machine yields a predictable 30% profit margin. Top-tier operators scale this to $700,000 a year by specializing. They bypass standard snacks to sell electronics or beauty products in 30 to 40 strategic locations. The trade-off here is logistical. While it scales easily, you are responsible for restocking routes and the risk of machine vandalism until you can afford to hire a dedicated driver. The final category is the heavy capital moat. These are for investors who want semi-passive wealth preservation and are willing to pay for it. The barrier here is financial. You need to secure commercial loans and invest hundreds of thousands into specialized machinery and real estate. That high entry cost creates stability. Laundromats, for example, maintain a 5-year survival rate of 94.8%. Modern automated car washes have further improved this by switching to subscription models. By charging $20 to $40 a month, they create recurring revenue that doesn't depend on daily weather patterns. The scale of the storage industry is even more pronounced. There are more U.S. self-storage units than McDonald's and Starbucks combined. This model yields an average 41% net margin. This is driven by a simple human habit. Customers often rent a unit for over a year simply because they forget what they stored inside. The trade-off for these moats is risk concentration. You get the highest survival rates and margins, but take on significant upfront debt and equipment liability. Generational wealth is rarely found in the newest trend. It is found in the daily problems that people will always pay to solve. Decide your path based on your capital. Under $10,000, take path A. Focus on wash and fold or striping to bootstrap using labor. Over $50,000, path B is better. Invest in laundromats or self-storage to build a defensible, high-margin asset. The most dangerous thing you can do is stay in analysis paralysis, waiting for an idea that feels more prestigious. Pick a boring problem, roll up your sleeves, stop waiting for the perfect moment, and begin the real work today. Which resource are you ready to commit? Time or capital? Tell me in the comments and subscribe if you're ready to start.